Yeah, we never got to.
Oh, yeah.
Okay, folks. Your quiz is day after tomorrow, in case I haven't told you that before. I'm just being facetious. Yeah. But it'll be in the first 30 minutes of class. So try not to be late because that'll mean a significant portion of the quiz. It is open book, open notes. I understand many of you have your slides on your iPads or your laptops. You can leave them open for the slides, but you cannot use any tools on no Excel spreadsheet. I do that for your, I've actually experimented. I've allowed people to use Excel spreadsheets. It's a nightmare when you have 130 people all working with Excel, the clicks and the booms and the sounds that come from it. And it actually takes more time, like, because you've got to copy things into a spreadsheet. So it's for your own good. You might not believe that because, I tell that to my kids and I actually don't believe it myself, but it is for your own good. So treat it like an old-fashioned quiz, right? You got a calculator. I know some of you have your calculator in your device as well. You might not have a physical calculator. That's okay. So if you open up an HP 17B on your iPad, you can actually download a free version. That's okay. But think of it as, and you will be answering the questions on the quiz itself. So no extra sheets are needed. There'll be space in there so you can end and show your work. I really want to give you credit for what you know, not take away credit for what you don't. I'm looking for reasons to give you credit, so make it easier for me, right? So you can write in sequence and steps that I can read, that helps. So first 30 minutes of the class, next session. So today I want to complete much of the rest of the discussion of cash flow, a lot of loose ends to tie up. So I thought I'd start with our usual start of the class test. So let's start by asking a couple of questions. One of the issues we're going to run into, and at least 1 in 5 of you, roughly speaking, should have a money-losing company, is what to do about losses. See why losses make life a lot more difficult. If you start with a positive number, with earnings, there's always an easy way to get whatever number you want, right? Just try higher and higher growth rates in earnings, and you're going to get to value. But we start with a negative number, that negative number gets in the way. So one of the ways in which people get around a negative number is by normalizing earnings. Sounds fancy, but here's what they mean by normal earnings. They take the average earnings over the last 5 years. You see this with commodity companies, cyclical companies. We're effectively replacing the loss from the most recent year by the average earnings over the previous 5 years. Implicitly in valuation, we make assumptions all the time. Yeah, but let me list out, whether these, whether I'm making these assumptions, and if so, why I need to. First, am I assuming that the loss I saw last year was unusual and the company is historically profitable? Am I doing that when I repeat? Yeah, right. I am making that assumption. So already you can see if you have a company whose loss last year was not unusual, it's got structural problems, its products are not selling, you can't normalize. So that's the first assumption. Second, I'm also assuming that whatever problems caused the loss are temporary, they've gone away now, right? There was a strike last year, or something happened to one of my customers and they couldn't buy it, but that problem's now gone away. Second, I'm assuming that as well. Third, I'm also assuming the business has not changed in fundamental ways. There's been no disruption or something that's kind of changed the profitability of the business. Yeah. And fourth, and this is something I think that we run into all the time in valuation. When you take the average dollar earnings over the last 5 years, we're assuming a company has not scaled up or scaled down. If your company is scaled up or down, you should be using a percentage, average margins, average return on capital. I'm making all of those assumptions every time I normalize. So the next time you see an equity research report where people normalize earnings, average over the last 5 years, implicitly they're making all of those assumptions. And if any of those assumptions break down, your valuation falls apart. GM and Ford look cheap, very cheap, if you average earnings over the last 5 years. But what we're missing there is the entire auto business has been disrupted so badly, we have no idea what the future will bring. So we'll talk about what to do when you have a structural problem, something that's not going to go away short term. And many of you have companies where that's the case. But some of you might have companies where it's a one-time problem, it's gone now, and you can go back to normalizing and replacing the negative numbers. Towards the end of this class, maybe we'll get to free cash flow to equity. We might not to the very end. But the free cash flow to equity is what's left over after you've met every conceivable need. So let's say you're valuing a company. We projected our free cash flow to equity for the next 5 years and beyond. Remember the don't give up proposition where you have negative free cash flow to equity, and I said the company can still be worth a lot if it gets disproportionately large positive cash flows. Young startups, often that's the case. Some of you are valuing young companies. So when you project out the free cash flow, you're projecting our free cash flow negative, 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 and eventually good stuff starts to happen and your cash flows turn positive. So when you have a company like that, your free cash flows equity or free cash flow firm are negative for the next 5 years. What are we implicitly assuming the company is going to be able to do in year 1, 2, 3, 4, and 5 with those negative free cash flows to equity? I have a negative free cash flow to equity of minus $1 billion in year 1. What am I implicitly assuming the company is going to be able to do? Yes?
Not run out of cash in that time?
Well, more than that, right? It's not just run out of cash. They have to go out and raise $1 billion in capital in year 1. Year 2, another minus billion, another billion in cash. Year 3. So implicitly, not only am I assuming I'm getting the free cash flows right, I'm assuming that the capital market stays open and accessible for me to raise more capital. Is that a safe assumption? In good times, we make it all the time, right? And then we wake up and they say, oh my God, there's no capital out there. We systematically overvalue young and risky companies in good times because we assume the capital conduits stay open and accessible. And if that breaks down, I mean, you know how many startups have had to shut down in the last 2 or 3 years because risk capital has dried up? And they were valued very highly before. It's not even that their prospects have dropped off, but without the capital to keep them going, they will not survive. So we're going to talk about how to bring in that survival risk with young companies because we can't safely assume that the free cash flow equity will be covered by capital markets from now through year 5 or 6 or 7. So we'll more explicitly talk about both issues, but something to factor in as you look at any. So let's go back to where I left you. I set up the big picture, right? Free cash flow of the firm, free cash flow to equity. The big difference between the two is free cash flow of the firm is a pre-debt cash flow. Free cash flow to equity is a post-debt cash flow. Let's now talk about specifics. I mean, much as I like to dump on accountants, the truth is every measure of free cash flow starts with an earnings number. You start free cash flow to equity with net income, free cash flow to the firm with operating income. And I know this shouldn't need to be said, but I'm going to say it anyway. If that accounting earnings number is screwed up, your free cash flow is going to be screwed up as well, no matter how many gymnastics you do. So your first stop is to make sure that that earnings number you're beginning with is a number that, I wouldn't say trust, that's too strong a word, but it's a good base for what this company is delivering. So the 3 adjustments I routinely have to make when I open up the financial statement. You're saying it's already there. Why should I check it? Here's the first. One is I want to make sure the number I'm using is the most updated value that I can get. We talked a little bit about this last session about not using the last 10K, especially if your last 10K is from 2022. If it's from 2023, you got lucky. You want the most updated numbers. So I'll talk a little bit about updating. Second, we talked about this normalizing issue, valuing a commodity company, a cyclical company. If last year was a bad year for that commodity, what you get as earnings is not a good base year. If last year was an extremely good year for your commodity, the same problem applies. So normalizing is about how do you get around the fact that earnings go up and down in cycles. And the third issue to me is the most difficult one. We trust accountants to stay consistent. In what way? That when they say something is an operating expense, a capital expense, and a financial expense, that they actually mean what they say. And I'm going to talk about two items that we run into every day. One of which accountants used to routinely miscategorize until 2019, leases, a financial expense that was treated as an operating expense, and the other R&D, which they continue to miscategorize as an operating expense when in fact it's a capital expense. So, and the template we're going to design there is not just for R&D and leases, for expenses like those. And I'll explain more about what those expenses might be. So let's start with the earnings update. Now, luckily, we live in a time when getting the most updated numbers is easier than it used to be. It was a time when you used to have to go out and collect a 10K and a 10Q and do it yourself. Then it's not difficult to do it. It's doable. But now, if you go into almost every publicly accessible financial capital IQ, will give you a last 12 months column, which basically is the last 4 quarters of data. That number is still going to be a little stale, right? Because for some of you, it might be as of September 30th of 2023, but it's better than going to December 31st of 2022. So my suggestion is we have trailing 12-month numbers, use them. In fact, all you need to get a trailing 12-month number for your company is 2 financial statements, your last 10K and your last 10Q. Because in your last 10Q, you always get that updated last 3 quarters, this year, last 3 quarters of last year. But updating is critical because you're valuing your company as of today. This isn't some stale exercise from the start of the last year, the start of your, because you got to make your buy or sell today. In fact, I'll go further and say, if you're in a country where you don't get quarterly statements, you might still get pieces of statements updated, like revenues and operating income. Take what you can get, update what you can get, and keep moving. Don't allow consistency to become the enemy of updating. What I mean by that is some people say, if I can't update every item, I'm not going to update any of the items. Update what you can, and because that will give you a better valuation than staying with stale numbers. But let's talk more about the accounting inconsistencies that you run into. And as I said, there are 2 categories of accounting miscategorization. So first are financial expenses that are categorized as operating expenses. Now, when you ask accountants what are financial expenses, most of the time they say interest expenses, and they'll stop there. And until 2019, there was one very large grouping of financial expenses that were treated as operating expenses, which is leases. Okay? And here's why leases are really financial expenses or debt. To me, what sets debt apart from equity is it creates a contractual claim. When you sign a lease contract, to me, it's a contractual claim. You've agreed to pay $1 million every year for the next 10 years. There's no difference to me between that and entering it and having a term loan from a bank where I pay off $1 million every year for the next 10 years. I've never understood the accounting logic for treating as an operating expense, but until 2019, this was by far the biggest single source of off-balance sheet debt. 85 to 90% of off-balance sheet debt was really leases. All that other fancy stuff was the remaining 10 or 15%. So you're a retailer, you're a restaurant, your biggest debt was not on the books. So we got to fix that. That's clearly a problem. Starting in 2019, I'll talk about what accountants have started doing. They've at least moved in the right direction. But in true accounting form, they've been half-assed about it. We'll talk about what the half-assed part of it is. The second group of expense I want to talk about are expenses that create benefit over many years, capital expenses, R&D being the classic one. And we'll talk about the logic that accountants use for treating them as operating expenses and why the logic doesn't hold up. The pain in the neck here is you're going to take existing financial statements and have to redo them because it's not just fixing one number, it's going to change everything about the company when you do it. So let's start with leases. just to give you a sense of which kinds of businesses or sectors have the biggest lease exposure, I took my 95 industry groups and I looked to see which industry groups have the highest lease expense as a percentage of revenues. So you can see air transport, trucking, restaurant. These were the businesses where debt was not showing up in the books until 2019. And at the other extreme, you can see there are businesses where leases are not an issue at all. So what I'm trying to set you up for is you picked a company. For some of your companies, leases are not a big deal. For some of your companies, it is a big deal. So you should expect to see some disturbance in your balance sheet as a result. So let's talk about the logic of why operating leases are debt and how to convert those commitments to debt. As I said, in the US and Europe, you might have saved yourself the trouble, but I want to take you behind the curtain to see what accountants are doing to capitalize lease commitments as debt and what they're missing in that correction. If lease commitments are debt, the contractual commitments, to convert lease commitments to debt, here's all I need to do. I need to take the commitments you have in future years. These are contractual commitments. And US companies have had to report this for 50 years as a footnote and take each commitment and discount it back to today using the pre-tax cost of debt as the discount rate. Let me repeat that again. You're going to take the commitments, year 1, year 2, year 3, year 4, and discount them back at the pre-tax cost of debt. So I'm going to turn the question back on. It's not fair because I was the one who stated use the pre-tax. Why cost of debt as my discount rate, as opposed to cost of capital or cost of equity? Yeah. It's treating it like any other debt. Remember how we compute market value of debt, right? So why pre-tax, not after tax? Because the commitments are stated in pre-tax terms, right? They will eventually show up as tax deductions, but because the commitment table is in pre-tax terms, it is a pre-tax cost of debt because the commitments are pre-tax commitments, right? I could always take the commitments, make them after tax and discount them back. I'll get the same answer, but to be consistent, lease commitments discount back. Yeah.
I mean, there is I guess, an accounting benefit to treat leases as OpEx to.
No, and here's why it's not a benefit. It's a good point. With R&D, we can talk about the benefit. Leases, there isn't, because all you do when you capitalize lease commitments is you replace a lease expense of 1,000 with 2 expenses, an interest expense, which sum up to 1,000. So basically, you get the same tax deduction either way. All it does is moves an expense from above the operating income line to below.
Well, but do you get tax breaks on capital payments?
No, because remember, it doesn't show up as capital payments. It shows up as depreciation.
But if it did, it wouldn't get the tax benefit.
But ultimately, if you get a depreciation plus an interest expense,
okay,
which works out to exactly the lease expense, which mathematically it does, you get exactly the same tax reduction. So implicitly, you're getting the full tax reduction either way.
Yeah.
Yes.
So like if I'm a firm and I have a contract with one of my suppliers for like a fixed term,
You borrowed money.
is that considered debt as well?
Well, right now it should be. Even if nobody else does, you should be aware that you borrowed money, right? And the reason it matters is now when you go to a bank to take another loan, you have to remember they got that contractual commitment to me. So whether accountants treat it as debt or not, you as a business owner or as an investor need to treat it like that. It has the same implications as borrowing money. So that's why I said this has nothing to do with what accountants think. It's what you as a business or an investor has to think about. Entering into a long-term contractual commitment is essentially borrowing money. So your present value of lease commitments becomes debt. I'm going to go put it in the balance sheet as debt. But a balance sheet has to balance. So when I put lease debt on the liability side, guess what I have to create on the other side to make the balance? I have to create a lease asset. That's why if you open up the Home Depot's balance sheet, which I did a couple of days ago, there's a lease debt. And there's this lease asset. You say, what is that? It's the counter asset that I need from a balance sheet to balance. And I'm not done. Once I create an asset, what do I do in subsequent periods? Think like an accountant. I amortize it. You got to open the door. You got to walk all the way through. You can't just convert leases to debt and leave everything else unchanged. Your operating income will now have to get restated because you're going to add back the lease expense saying I should never have subtracted it out. And you're going to subtract out the depreciation on the leased asset, which will restate your operating income. So I'm going to take the gap and take you through the mechanics because in abstraction, it doesn't make much sense. Here's what I'm going to do. This was in 2003 when accountants were still out of their senses. They were treating leases as operating expenses. You know, somebody at the Gap who's an old student of mine said, can you come in? Because they were then talking about how they were going to, make this rule change in 2003. We talk about how long it takes for accountants to actually put through a change they're talking about. 2003, we'll talk. So the Gap's management wanted to know what would happen if leases were treated as debt. Before I take you through the mechanics, I have to tell you that the management went through various stages of delirium as I was presenting. They were very happy, then they were let down. They had no idea what was going on. So I'll explain the good news first. I said, if I capitalize leases, I'm going to take the present value of the lease commitments here. And the Gap had, contractual commitments. So this is in the footnote. That's always shown up. I took the lease commitments from the footnote. I discounted them back at a pre-tax cost of debt of 6%. The present value that I got for the lease commitments was $4.4 billion. If you looked at their balance sheet, you saw 1.9 billion in existing, 1.97 billion existing debt. I'm now going to add on an extra 4.4 billion. The Gap is a much more highly levered firm than it looks like once you capitalize leases. My operating income, which was 1,012 million, I added back the lease expense, saying I should never have subtracted it out, and then subtracted it out in depreciation. And I stayed with straight line, why go looking for trouble, to come up with an adjusted operating income. So my debt value goes up, my operating income gets restated, and here's how it's going to play out on the rest of the numbers. Incidentally, there's a shortcut you can use if you're in a hurry. But do this only if you're in a hurry, where you take the existing operating income, add back the imputed interest expense, because it's earnings before interest and taxes. So if you're doing thousands of firms and you say, I don't want to do this depreciation part, that'll give you a rough approximation you can use, but it's an approximation. So here's what the numbers look like for the Gap. So in the first column is conventional accounting. That's what the management is seeing right now. In the second column is what the numbers will look like if I treat leases as debt. Let's start with the good news first. With the existing accounting, it looks like you're making about $1 billion in operating income. If I capitalize leases by adding back the lease expense and subtracting depreciation, I end up with an operating income of 1.36 billion. Good news or bad news as a company? Your income went up. They were happy. This is great. I said, but here's some bad news. In the balance sheet right now, you're showing only 1.97 billion in debt. If I capitalize leases, it looks like you have about 6.2 billion. They got a little worried. Is that good? Is that bad? I said, from a cost to capital perspective, this is good news. Because remember, cost of capital is a weighted average of your cost of equity and the cost of debt. And if you have less debt, your cost of capital is going to be higher than if you have more debt. Your cost of capital go from 7.3% to 6.25%. This was the height of, they were, if that stopped right there, they said, this is amazing. Our earnings are going to go up. Our cost of capital is going to go down. Higher earnings, lower discount rate. This is like the best of both worlds, right? Yep.
But if your debt goes up, also your required return of equity will also go
Well,
up.
remember, it's happening across. How do we get our betas? We look at the unlevered beta for the sector. Every retailer has a lot of debt. If I treat leases as debt for every retailer, the unlevered beta becomes much lower. So your cost of equity, it's not just you that's using leases. Every company in your business is using leases. So unless you use a disproportionately high amount of leases, your cost of equity is not going to change if you're consistently doing it across all the components.
Yeah, but it's like sector-wide.
Sector-wide.
If your debt
But-
goes up.
But remember, but everybody in the sector now, because you all had this debt. It's not like you've raised the debt, right? You've always had leases. Now I'm converting leases to debt for every retailer. Every retailer is now going to have a higher debt to equity ratio. So it's not like your cost of equity is going up because you've chosen to borrow money. Everybody's chosen to borrow money or using leases. Now I'm converting those leases to debt for every player in the game. I'm going to come up with a higher debt to equity ratio for the sector and a lower unlevered beta for the sector. So when you do the adjustments right, the cost of equity will barely move unless you happen to be a retailer with a disproportionately high lease commitment. Then you might have a higher debt ratio, but it's coming from the fact that you have more leases than the typical retailer. So in general, you will find the cost of capital decreases for companies when you convert leases to debt. In general, you'll find their income goes up. Manish?
To clarify, straight line depreciation on for 7 years, that's the term of the lease.
Exactly. So if you have a 15-year lease, it'll be 15 years. So just keep it consistent. It'll be based on whatever the lease term is. But then I hit them with the final part of this puzzle, right? So you have higher earnings, you have a lower cost of capital. But ultimately, you get judged as a company based on the return on capital you make on your existing investments. Return on capital is one of the few numbers in finance where we use book values in the denominator. So based on the way accountants compute it, you're showing a low book capital at these companies because you're not counting their biggest assets on the books. The return on capital for the GAAP was 12.9% with conventional accounting. But if I convert the leases to debt, my return on capital decreases. So here are the net effects. I have higher earnings, I have a lower cost of capital, and a much lower return on capital. What will the net effect be on value? That was exactly the question they left. I said, in your case, it'll probably be negative. Why? Because the spread between your return on capital and cost of capital was 5.59% with conventional accounting. But if I capitalize leases, that drops down to about 3%. When I did this for Starbucks in 2008, they earned well above their cost of capital without leases being capitalized. But once you capitalize leases, they actually earned less than their cost of capital. I mean, this was when Starbucks was going crazy. I mean, there was a point in time, I think there are 110 Starbucks stores just in New York City. They were just opening up stores without thinking through, because this is exactly what happens when I don't treat it as debt and capital invested, is you think it's free. Eventually it caught up with them, and this is what it forces you to do. Think about it, what's actually invested in these stores. So when you capitalize leases, you'll always push up the debt value. You'll generally push up the earnings number. You'll push down the cost of capital, but you'll also change your return on capital. The net effects can be positive for some companies, negative for others. That's exactly why we do it. Because if the value didn't change, we wouldn't bother. It does change the value because it changes your perspective on the company. Any questions on converting leases to debt? Now, why am I counting leases as debt? Because they're contractual commitments. Okay? If I have any kind of contractual commitment, I'm effectively borrowing money, right? Let me give you two other examples. If you open up, anybody doing Netflix for their company? Somebody must be doing Netflix, no? Last year, 7 people did Netflix. I'm sure there's somebody doing Netflix here. If you haven't picked a company, pick Netflix. Right? You're watching Netflix every night anyway. You can view that as project work. Right? Netflix, if you open up to the footnotes, has lease commitments, but they also have content commitments. You know what those are? I mean, Netflix recently acquired the rights to Suits. It's actually the most watched Netflix show last year. They have the 5-year exclusivity to show Suits. The way they got it was by agreeing to pay, I think, $50 million a year every year for the next 5 years. Contractual commitment? Absolutely. That second column is content commitments. So even with all the original shows that Netflix produces, they still have a lot of rented. When I value Netflix, that content commitment is like that because it's a contractual commitment. Or if you're the Saudi team, Al Nassr, the one that signed Ronaldo, which one is that? I think it's Al Nassr. You know what Ronaldo's contract is, right? A heck of a lot of money for the next 4 years, $150 million for the next 4 years. Present value is debt. I mean, sports teams are incredibly indebted. If you think about the contractual commitments, think of the Dodgers balance sheet, right? You take each of the big contracts, you take the present value of the contracts, you add them up, you have effect. I'm not saying it's good or bad, but it's good to recognize what a company's borrowed when you look at it. Yes, I.
In the example of Ronaldo, like wouldn't that companies have to treat wages and salary?
Only if they're contractual. Most of the places you go to work for, there's not a contractual commitment. You can get fired and walk out. But if they sign employees for 10-year contracts, you've effectively borrowed money. Doesn't make it a bad thing. But now if you go out and borrow more money, you're asking for trouble. And that's effectively the advantage of treating this as debt, is it makes you more cautious about entering into further contractual commitments that might lower your value. Yes.
Say you use Amazon Web Services
Yeah.
to host your company, would that be considered debt since it's kind of contract?
It's not, I mean, as long as it's renewable. So if you have a bad year, you can walk away. You're okay, right? So if Amazon Web Service say, look, you've got to agree to pay us $15 million a year for the next 10 years, no matter what happens to you. Because really, you'll use this only if things don't go well, right? So you need to see what kind of escape clauses you've built in. The more escape clauses you build in, the less likely it is that I will treat it as debt. Yes.
And for the content commitments or sports people kind of commitments, how do you depreciate those?
Same way you would do any other, right? Right? Depreciation has nothing to do with the economics of Ronaldo getting older, not as good a soccer player. It's got just getting the asset off the books over the next 4 years. So just stay with straight line depreciation, do exactly what I did with leases and remove it from the balance sheet.
What should be the duration of the?
The length of the contract. Right? Yeah. So, yeah, go ahead, Manish.
Sure.
Yeah.
Can you also walk us through what will be the impact on cash flow to the firm?
The cash flow to the firm will get higher. The free cash flow to equity will be unaffected. Because all you've done is move something that was treated as an operating expense to a financial expense. So free cash flow to the firm will be higher because you're now treating lessors as lenders and treating them as capital providers. So your pre-debt cash flow is now a pre-lease cash flow as well. But the free cash flow to equity, which is after financial expenses, you end up with the same free cash flow. So let's, yes, go ahead.
So how would you look at a company like WeWork, for example, like their entire business don't have leases?
It's insanity, right? If you think about it. Now do you see why WeWork was a bit, even at its peak, you look at the company and say, who would think of such a bad business idea? And then throw billions of dollars in. The answer was Masa Son, and Adam Newman. But it was a terrible business idea precisely for that reason, right? In real estate, this has never worked, to enter into a 40-year lease commitment and then sublease it out for 1 year, because you're incredibly duration mismatched. You're a hugely levered company. And that leverage is going to blow up in your face because your income, it's okay if you take a 40-year lease and you have 40-year leases that you have as well, because at least you matched up. But their problem is a mismatch. So if you think about what accountants were doing until 2019, they were treating lease expenses, operating expenses, which means they were understating income for retailers, restaurants, etc. They were understating the debt on the balance sheet, and they were overstating the returns on capital of these companies. The reason we capitalize leases is to get a better measure of how much debt the company owes and a better sense of what are they actually making on their projects. Are they taking good projects or bad projects? And without capitalizing leases, you cannot answer that question. Okay. As I said, in 2019, I mean, I've been capitalizing leases from my very first edition of my valuation book, and every time I do data updates since the 1990s. Why? Because the data was always there, right? You could do it yourself. The raw data, the footnotes were there. But in 2019, both IFRS and GAAP came to their senses, at least on leases. And they said, you know what, leases are debt. And so finally they woke up to that reality. To show you how much of a lag there is and how between when accountants realize there's a problem and they fix it. I actually found this panel discussion from 1949, held at what was then called the NYU School of Business. It was an accounting convention on why leases should be treated as debt, 1949. 2019, finally something gets done. What's the lesson you get from this? Don't wait for accountants to do the right thing. It takes them an incredibly long time. And you can't blame them. They have a legacy problem, right? Because generations of CPAs have been taught the old rules, and now to change things, it takes forever. So starting in 2019, the accounting rules essentially require that leases be treated as debt. So you don't have to do what I did. That's the good news. The bad news is what accountants do has escape clauses, because there are lots of rules and companies can learn to play the rules. If you have enough escape clauses built into your lease commitment, accountants will not treat it as debt. So the numbers can be different even though you have the same raw data. So what I've continued to do even after 2019 is continue to capitalize leases myself to see how close to the accounting numbers I get. I'll start with the good news. If you're in the US, I'm pretty close. I came up with 1.15 trillion. Accountants came up with 947 billion. This is the collective present value of lease commitments of US companies. Now I'm about 82%, at least accounting number. And the remaining 17.7%, you can explain away by escape clauses, all the differences between the accounting rules in mind. But if you go to emerging markets, my advice is you should capitalize leases yourself. Don't assume the accountants have done it or done it right, because there's a huge gap between what I see as lease commitments in these companies and what I see as reported in debt. And part of it is companies, especially in Asia, are gaming the system. A lot of Indian companies actually have gone to their lessors and put in escape clauses specifically so they will not be treated as debt on the balance sheet. The advantage, at least so far, is the raw data is still there. The footnotes are still there. You can do it yourself. So I still have left that clause in that in my valuation spreadsheet. So do you want to capitalize leases? Just don't double count. Don't count the lease debt from accountants and do it yourself. Pick one or the other, but make sure leases get treated as debt and all the other adjustments get made. Here's the half-assed part of it, though. At least up to now, accountants are treating lease debt on balance sheets, but they're not making the adjustments to the operating income. It's a very weird, they're acting as if the old rules apply for income statements, but the new rules apply for balance sheets. I've never understood this. In fact, I'm supposed to be talking to an IVSC, International Value Standards Committee board, it's an accounting board tomorrow. And one of the questions I'm going to ask them, what were you thinking? You're going to capitalize leases, treat it as debt, at least do it right and do everything based on that assumption. So there's this strange mix right now of rules. One of these days they might fix it, but it might take another 70 years before that happens. Let's talk about R&D. The logic for why R&D should be CapEx is a very simple one. If CapEx is any expenditure designed to create benefit over many years, R&D is super CapEx. But as long as I've been watching accounting, in much of the world, there are exceptions. If your R&D is close to commercial use, they let you treat it as an asset. R&D is treated as an operating expense. And to show you the sectors where you're going to see the biggest effect, pharmaceuticals, technology, R&D is your big CapEx. It's not land, building, equipment, factories, it's R&D. Take a company like NVIDIA. It doesn't make its own chips. R&D is its biggest CapEx. And right now, the accounting is all screwed up. So my logic for treating R&D as a CapEx is the accounting first principle I was taught in my first accounting class. If you get benefits over many years, you should be treating it as a CapEx. So what do you think the accounting logic is for continuing to expense R&D? I think we started this, but I want to make sure it gets nailed down. Why do you think accountants continue to expense R&D? There must be an accounting rationale for what they're doing, right? Because it violates their own first principles.
Is it because ideally, what you're investing in expenses like that are building something that would eventually be goodwill?
Goodwill is not an asset at all, right? Ultimately, it's about creating future earnings. But wouldn't you say that investing in R&D meets that criteria? I mean, I would say building a factory is about creating future growth, but so is R&D. So from that perspective, it seems to me it should be CapEx.
I mean, is it seen like a cost of goods sold?
But in what way can it be called? Because it's not definitely not connected. In fact, that logic, it's not connected to goods sold. Yep.
Is it tangible? Is it intangible?
That's part of it. They like to see it. But here's the inconsistency. If I buy a patent, they treat it as CapEx. But if I do R&D to create the patent, it's treated as an operating expense. So the tangible, intangible breaks down. When I do an acquisition, they treat that intangible, they call it goodwill, right? Yeah.
Because there is no certainty of liability.
Now we're thinking like accounting. They said this, in fact, but 13 years ago, I was asked to give the keynote to the AICPA conference. It's a scary conference, like 1,000 accountants in a Las Vegas ballroom. So it's close to vision of hell that I can get. So I show up there and I don't think I'll ever be invited back. And that was part of my objective, is to make sure I did a presentation on 10 things accountants do that I don't quite get. That was the title of the presentation. And this was one of those things. Why do you keep expensing R&D? They threw this uncertainty at me. I said, let me get this straight. So if something is uncertain, you let me expense it, right? He said, yes. So if I build a factory to make the next next, generation of tablets as a computer firm, you'd let me expense the factory. He said, no, we won't let you do that. So it's just on R&D that you draw on uncertainty. If uncertainty is the dividing line, investing in uncertain businesses, building a factory should be expense, but you don't let me do that. So uncertainty is the excuse they give, but it seems to be very specific to R&D. Then they said, we're just being conservative. We're accountants. You see why it's conservative, right? By expensing R&D, you're lowering income. They said lower income is more conservative than higher income. But there's a catch here. When you expense something, it doesn't show up on the balance sheet by definition. So while you're showing lower income, you're also showing almost no book value of equity, no invested capital. So any ratio I compute to see how good you are as a company is going to get completely blown up. If you don't believe me, take the return on equity, return on invested capital for many technology firms. Take the Mag 7 that I put out, compute the traditional accounting returns. You get mind-boggling numbers. Apple's return on invested capital is infinite. The return on equity is like 350%. I like Apple as a company, but they're definitely not making 350% returns on their projects. But because your book equity doesn't include your biggest assets, of course you're going to get outlandish numbers. So let's get this out of the way. Uncertainty is not a good excuse, and you're not being conservative. This is a terrible practice. So guess what? We can't wait for accountants to come to their senses. We've got to capitalize R&D. So here's the template for capitalizing any expense you want to capitalize, not just R&D. You start by specifying what's called an amortizable life. Sounds fancy, but tell me on average how long it takes between the time you do R&D and a commercial product emerges. I know you're saying that's going to be difficult to do. I agree, but give me an average number. Is it 3 years? Is it 5 years? Is it 10 years? If you're a pharmaceutical company, what do you think the answer is? You do R&D, then what happens? Something interesting comes out, and you have a stage 1, then stage 2, then stage 3. I mean, let's face it, the COVID vaccines were the exception to the rule, right? 8, 9, 10 years between the time you start research. So start with that. Could some research not pay off? Of course, like any other investment. So give me an average number. Second stop, I'm going to go collect R&D expenses every year for that period. So if you tell me your R&D takes 10 years to pay off, I'm going to get R&D 1 year ago, 2 years ago, 3 years ago, all the way back to 10 years ago. See, why are you looking backwards? Because if I decide to capitalize R&D, I can't start right now. I've got to act like I've been doing it all through. So if I have a 10-year life, guess what I'm going to do with my R&D? I'm going to write off 1/10 each year rather than treat it as an expense in that year. And I'm going to keep track of 2 numbers, how much I'm amortizing this year and how much of the previous year's R&D is still unamortized. So let me give you an example. Let's take a company like SAP, German software company, but it's more business software, so it takes a little longer for R&D to convert to products. So I'm giving it a 5-year life. So I collect the R&D expense from the most recent year, 1.02 billion euros. And there are the R&D expenses each year for the last 5 years. Let's take the R&D expense from 5 years ago, 745 million. If I'm capitalizing R&D, I'm writing off the last 1/5 this year, and there's nothing left over. So the last 1/5 of the R&D from 5 years ago is being written off. R&D from 4 years ago, I'm writing off 1/5 this year, there's 1/5 left over. R&D from 3 years ago, I'm writing off 1/5, there's 2/5 left over. So I'm always writing off 1/5 this year, but I'm also keeping track of what's left. And the more recent R&D, there's more and more left that's not been written off yet. If you add up the last column, you come up with 903 million euros. If I'd been capitalizing R&D all the way through, that would have been what I'd have amortized this year and shown as an expense this year. And the second to last column, which is 2.9 billion, will now show up on my balance sheet, for lack of a better, let's call it R&D asset. It's basically money you've invested in R&D. Whenever I do this, people say, but you're giving the company credit for things that might not work out. This is, I think, comes from the misconception that putting something on the balance sheet is rewarding a company. From an intrinsic value standpoint, when I put something on a balance sheet, I'm actually holding the company up to a higher standard, because now what does the company have to do? It has to deliver enough earnings to justify what you've invested. I'm trying to hold companies accountable for the billions of dollars they're putting into R&D to make sure they're delivering enough income to justify that investment. Because right now, it's just disappearing into thin air every year. There's no accountability because nobody keeps track of you take a company like Merck, spent $100 billion in R&D between 2008 and 2018, had nothing to show for it. Somebody should have been asking, why are we throwing good money after bad? But it took them a decade to catch up because it wasn't being accounted right. So if you track it through, here's what you're going to see in a typical high R&D company. When you capitalize R&D, if you take SAP, their operating income increases by about 117 million. Why? Because I'm adding back the R&D expense and subtracting out the amortization. Incidentally, for the tax purposes, because you're allowed to deduct the R&D expenses, you're going to continue to do that. This is just from a valuation perspective or to get a better sense of what the true earnings are. So SAP is a much more profitable company than it looks like once you capitalize R&D. If you go to the balance sheet, my book equity, which was 3.8 billion, jumps to 6.8 billion. Why? Because I brought the biggest asset onto the books, the 2.914 billion now becomes an asset, pushes up my book equity. If you look at the capital expenditures, if I hadn't capitalized R&D, it looked like SAP was reinvesting almost nothing. They don't build factories, they don't have equipment. But once I capitalize R&D, the net capex increases to 119 million. But here's the thing that's most puzzling. If I compute the free cash flow to the firm with R&D capitalized, I get exactly the same free cash flow with or without. You're saying, why did we go through this torture if the free cash flow to the firm is not changing? Because the ingredients change, right? This company is making more earnings than I thought it did, and reinvesting more than I thought it did. I end up with the same bottom line number, but it gives me a very different perspective for the future. Because when you're reinvesting tiny amounts, you're not going to grow fast. Now I can give them growth because they are reinvesting, but it takes the form of R&D. So capitalizing R&D is going to change everything again. It's going to change your earnings. It's going to change your book equity. It's going to change your reinvestment rate, the percentage you're putting back in the company. And it's giving you a much cleaner look of what your company truly is doing. Any questions on? Yes, go ahead.
Can you explain why you increased the existing shareholder number of shares?
Well, you put an asset on the asset side of the balance sheet, right? There are only two items on the other side, debt and equity. So you got to decide where it goes, right?
I don't understand that.
Why it goes in the book.
The person, the people who are holding the equity, how does that impact them?
Well, where did the R&D come from? It came out of after-tax earnings that the company put back into the company. Whose money is that they were reinvesting? There you go, right? It's equity investor money that Merck was investing for those 10 years that I now have to add to the book equity. Right? So the reason we put in equity, so with leases, debt went up. With R&D, it's equity that goes up because that's the number that carries that difference. Next. So any other questions on R&D? Are there other expenses like R&D? Yes, we listed a few, right? If you're an oil company, what's the analogous item to R&D you're going to see in their income statement that account is expense? Exploration costs. If you're a consumer product company whose value comes from brand name, it's a big chunk of your advertising. If you're a platform company like Uber or Airbnb, it's the customer acquisition cost. The 21st century company, you can almost guarantee accountants are not getting the CapEx right because the biggest assets don't take the form of land, building, equipment, machinery. And what we're creating is a template which you can use to capitalize customer acquisition costs at an Uber. And we need to do this to hold these companies accountable because they keep telling us how many new users they're getting. And this brings in the other half of the equation. What is it costing you to add these users? And is the net effect positive or negative? Yes.
Like customer acquisition cost in terms of marketing would be also considered like
Big capital expense, right? But I'd have to ask you a question. How long does a customer you acquire stay on? If your customer comes and goes, then it's the operating expense. So, but if your customer comes and stays on, and this is why churn rates and renewal rates become so critical in platform businesses. When Netflix gets a new subscriber to sign on, let's say that somebody wants to see Suits and decides to sign on to Netflix, that customer has a 95% chance of renewal. That means the average life you're looking at is 6 or 7 years for a customer. So when I capitalize customer acquisition cost for Netflix, it'll have a much longer life than a customer acquisition at Groupon. Where you come, you take advantage of an offer, and then you leave on. There's nothing sticky about the model. So I'm not going to give all platform companies an equal license to do whatever they want with customer acquisition costs, because in some cases, it's really closer to operating expenses. But that's a healthy question to ask, right? Because we allow these companies to tell you how many customers they acquire. But we never ask them the follow-up question, how long does a customer stay on as a customer? And this forces you to ask that question. So let's see what accounting right now is doing by treating R&D as an operating expense. It's understating earnings at technology firms. Next time you hear somebody say, the PE ratio for Microsoft is so much higher than the PE ratio for Coca-Cola, remind them of the problem. The earnings for Microsoft are understated because their biggest CapEx is being, I mean, did you take a look at how much Amazon spent on R&D? I don't even know where they spent this money, $86 billion. Where did that money? I have no idea, but they're clearly spending on something. But that's affecting their earnings. So when you see the low margins for Amazon, and you say that's only a 6% margin, remember that's after their biggest CapEx has been taken as an operating expense. Second, it understates their book equity in there. So when you compute things like return on equity or return on invested capital, you're going to get sky-high numbers. The reason we capitalize R&D is exactly like in leases, to get a better sense of what is this company actually making on its business. How much is it reinvesting and how well is it reinvesting? Fundamental questions in valuation that you cannot answer until you capitalize these expenses. So that's a cleaning up for accountants. You can see it's not just R&D, it's not just leases, expenses like those. Now, when you sit down to value a company and you look at the most recent year's income statement, you sometimes see extraordinary charges, one-time charges. And companies have become very clever about moving these charges below the operating income line. That's just a one-time charge. Let's think of how you differentiate between companies that deserve to be given the benefit of a one-time charge from companies where you have to be a little more discriminating. Let's say you have a company that is reporting a loss of $500 million last year, but they had a $1 billion one-time charge last year. If it's truly one time and you're valuing this company, what should you do?
Add back.
Ignore the billion, right? So it's one time, it's gone. I'll just add back the entire billion. It's gone, right? It's a sunk cost. The fact that they lost money last year is kind of irrelevant because, so when you have a truly one-time charge, it's fixable. But let's say you look at this company's history and you notice something very interesting. Every 5 years, you see a one-time charge of $1 billion. You got to get a little suspicious, right? Saying, how come every 5 years? Because it looks to me like you took an operating expense of $200 million a year, lumped them up, and took a one-time charge. You're saying, why would companies do that? Because they're playing the analysts, because the analysts look at EBITDA and they look at EBIT and it's before these extraordinary expenses. The more they can move below the line, the higher the pricing. Analysts they apply 8 times EBITDA. You're tempting me to move numbers below that line. And that's exactly what companies are doing. So if you had a one-time charge every 5 years of $1 billion, how would your answer be different? What would you do differently?
Well, because it's no longer one-time expense, you have to treat that as an.
In this case, that would mean that's like a $200 million expense every year. So instead of showing a $500 million loss, you'd show a $300 million profit. You'd add back 800 million out of the 1 billion, saying in a typical year it would be 200 million. Your normalized income would then be 300 million. This is the advantage of using S&P Capital IQ, because you can download your company's financials going back as far as you want in time. Most of the time, I'm not looking at 1988, 1990, 1991, because the company is very different, but I'm looking for items like one-time charges, because I want to see whether this company is playing games with me. And if they are, I want to adjust for that. And the only way to find out is to look at the company's history. I remember valuing Xerox a long time ago when the company was actually a company and not just a name. Now it's just a trademark floating around. And it's 7 years in a row where they said we one-time charge, one-time charge, one-time charge. And you have 7 one-time charges in a row. That's not a one-time charge, it's a 7-time charge. That's an operating expense. And so it's a judgment call you got to make. If earnings are your starting point, and I said the earnings are screwed up, your cash flows are going to be screwed up. This is your biggest nightmare, right? You're trusting the accountants not to commit outright fraud. Because if it's accounting rules, you can kind of but what if they're committing fraud? The answer is not much you can do. And after the fact, you can always complain. But there's an area of accounting called forensics. It's developed primarily since the Enron fiasco. Forensic accounting is perhaps the only interesting accounting area, if you think about it, because it's not about rules, but about going through financial statements, looking for clues that a company is committing fraud. I'll give you one example. When you look at an income statement, you have an accrual income that companies report, right? When you go to the statement of cash flows, they take that net income from the income statement, then they add back the non-cash charges and subtract change in working capital to come up with a cash income for the company. And for many companies, in fact, for every company, those two numbers will not match up. But for a healthy company, some years the accrual income will be higher, some years the cash income will be higher, and you see it go back and forth. If you have a company where the accrual income consistently runs ahead of the cash income, you got to get a little suspicious because that's not natural. Something is being done to make the income. They're selling items on credit, posting it as income and not collecting on the cash flows. Again, it's not a guarantee that there's accounting fraud, but that might be a clue. Or an effective tax rate. The effective tax rate, remember, is based on the income statement. It's accrual taxes paid divided by taxable income. Take a look at your company's effective tax rates over time. If you have a normal, healthy company, it'll go around 16, 19, 11, 15. But if you have a company where the effective tax rate goes from 83% to minus 55% to 133% to minus 16%, this company is definitely maintaining two sets of books. A set of books for taxes and one for... But those are the kinds of clues that forensic accounting is about. None of the clues by itself is a guarantee that there's fraud, but if a collection of clues comes together, this is what the big short sellers have as their biggest competitive advantage. You look at Hindenburg Group, which does a lot of short selling. They go through the financials looking for clues that something is not right in the company. So if you want, I'll send you a couple of links to readable forensic accounting books. That's a subset of actual forensic accounting books, where you can say, these are the 10 or 12 clues I would look for in a company. Go through your company and hope you don't see those clues, because it just completely undercuts all evaluation if you don't trust the accounting. Any questions on accounting fraud or forensic accounting? Let's talk about money-losing companies. How many of you are doing money-losing companies? As I said, I expect to see a fair number of hands here. Okay. No, who are you doing? And have they ever made money? So the money-losing company. So you have a money-losing company that's never made money because it's a young company that's looking to a hopefully brighter future, or? Hope so. Okay. Anybody else doing a money-losing company? Yes. Who are you doing, Pari? And has it ever made money?
Just a little bit in the.
So at least your company has made money in the past, money-losing company. Who do you think has a tougher challenge? Person who's never made money, obviously is starting from scratch. I mean, I'm not suggesting your challenge is not there, but it's a different kind of challenge. So if you look across money-losing companies, not all of them are created equal. So I'm going to break down money-losing companies to 4 groups. And if you picked a money-losing company, think of which of these 4 groups you'd put your company in. The first is a company where the losses come from a one-time or an extraordinary. Something happened last year that made them lose money. But historically, they've been money. This is your easiest company to fix, right? Here you can normalize earnings and move on, because you're essentially assuming that what happened last year is gone. You could have a money-losing company with a commodity or cyclical company in 2020. Every oil company in the world lost money. Why? Because oil prices dropped down to $30 a barrel. Here, again, a fixable problem, right? Because you assume cycles are going to come back, oil prices are going to bounce back. You could be wrong, but again, you fix it. So in the first 2 cases where you have either a one-time loss or a commodity cyclical company losing money, the problem is relatively easy to fix. You can fix it by normalizing earnings, replacing the negative number with a positive number. The last two cases are tougher. If you have a young company that's losing money, it's a feature, not a bug. That's exactly what you'd expect. That problem is not going to go away next year. It might not even go away 2 years. It might take the next 5 years to fix. You can't just replace your negative number with a positive number. You got to develop a pathway to get from your negative number, your losses, to profits. We're going to talk later in the class about setting a target margin. How do you fix a target margin for a company that's never made money? If you're an intermediary, you might look at other intermediary companies. If you're a retailer, you might look at retail companies. But that becomes a key part of your valuation, is picking that target. And if you have a company which has structural problems, I don't think GM and Ford are going to get fixed overnight. There you might have to devise a pathway to getting past those problems and ask the question, what if I don't make it? So the last two cases, you're essentially looking at long-term fixes to the problem rather than short-term ones, because the problem is not going to go away short-term. So there's no one template for money-losing companies. It depends on why you're losing money and what will cause those losses to turn to profits. That then gets built into your valuation in your forecast. Yes?
I'm valuing Uber.
Uh-huh.
If you consider, because
They finally made
Yeah,
money
they
this
finally
year.
made
So
money.
you're out of the problem, right? At least you have a starting number. But for Uber, what's been their challenge? Why? I mean, this is a company that's always had this immense growth, right? Went from 3 cities to 410 cities in like 3 years. What's been the fundamental business problem that's prevented Uber from making money?
I mean, because
Well, the drivers, I mean, basically,
Yeah.
they're the ones who actually are the company. Without the drivers in the cars, there is no company. But it's the fact that early on, how did Uber grow so fast? I mean, some of you have been using Uber for 10 years or so. It's been incredibly cheap. I remember taking a Uber from the airport to the city for $23. And I said, there is no way anybody in this business is making money. The driver's not making money. The company's not making money. They subsidized, right? They subsidized because they wanted to grow. So initially their losses were subsidized, which is fine, right? Once you build up, what do you hope? You can hope to raise prices. And that was Travis Kalanick's dreams. Once you build the market, then we can raise prices. And that's where they ran into a challenge, right? Because when they tried to raise prices, they discovered they had a competitor. All they need is one competitor, in this case, Lyft, essentially challenging them at every step of the way. This is a business that has historically had no stickiness. I'll explain exactly what I mean. This morning, I took the red eye from California last night. I came in this morning and I got in Newark Airport at 5 o'clock in the morning. And to take a car to the city, I checked Uber and I checked Lyft, and guess which one I took? I took Lyft because it was cheaper. Not because I like Lyft or I am actually an Uber shareholder. You say, why aren't you? Because my shareholder brain and my consumer brain are separate. I have no loyalty. There's no customer stickiness. The driver who drove me actually had both Uber and Lyft on his car. He has no stickiness. You cannot build a business model that delivers profits without stickiness. That's why in parts of the world you become monopolies, right? In China, you've gone to Didi. In Southeast Asia, it's Grab. In the Middle East, increasingly, it's Careem, I think, is own. But you're noticing that ride-sharing companies are becoming, because if you have competition, it's very difficult to make money. Uber's biggest market continues to be the US, where they have Lyft as a competitor. There's an element of price fixing going on. This morning, my Uber cost me $68. Cheap still, but not $23 anymore. And this stage, they're probably asking, where are you going to go? Right? Yeah, I mean, who wants to go stand in the line for the yellow cab anymore? Right? They're effectively taking advantage of the fact that the traditional taxi cab competition is gone. And if Uber and Lyft can both raise prices, there's an element of antitrust and duopoly you got to get around. You could potentially see both companies make money, but it's a very precarious steady state. Because all you need is one of the two to break the rules and start competing on price, and the whole thing will come apart. So Uber's profits are there, but they could be gone next year. And that's going to be a challenge in valuing Uber. How do you build up stickiness in a model? Any ideas? How would a ride-sharing company build stickiness? They'll make you, they could do airline, like airline miles, Uber points.
Subscription stuff.
They tried subscription, but the problem with the subscription model with ride sharing, and this is a good way to think about subscription, is subscription models tend to break down when you have a wide variance in usage across customers. Do you see why? If some people are using $500 worth of Uber every month and others are using only $7, guess who signs up for the subscription model? The 500. You get your biggest customers actually then paying far less than they would. So Lyft and Uber have tried the subscription models, but very quickly had to abandon them because it starts to break down given the variance in usage. I don't think there's an easy fix. I think they're both struggling with how to do it, but it has to be done. No ride-sharing company makes money consistently. Didi loses tons of money. Grab loses tons. Ola loses tons. This business is still trying to find a business model that works. And this was the last decade, right? We threw money at companies before their business models, and then we wondered why they didn't make money. So it's good to have a starting point, but you still have to make a judgment. Can they sustain it? What's going to change in this business? Because that's the only way you create value. So you got your operating income, you cleaned up for leases, you cleaned up for R&D. You need a tax rate, right? Remember, you multiply the EBIT by 1 minus the tax rate. So I'm going to give you the choices of tax rates, and you tell me which one you would use to compute your after-tax operating income. I could use the effective tax rate, which comes right out of the income statement. Taxes payable divided by taxable income. Every company reports this. I could compute my own tax rate by taking the taxes paid and dividing by operating income, which would be lower than the effective tax rate because I'm using EBIT. I could use the marginal tax rate for the country in which I'm incorporated, which is what we did with cost of debt. I could use some kind of weighted average marginal tax rate of the many countries that I operate. Maybe the answer is none of the above, but if you make that choice, I'd like you to tell me what you would use instead, because you have to use some tax rate. Or maybe this would be nice if it were true. You can use any tax rate you want as long as you stay consistent and use it all the way through. If that were true, what tax rate should we use in valuation? What's the easiest tax rate to work with? 0. If taxes, all you had to do was be consistent, we would never care about taxes. So clearly that last choice is not there. Really the question is effective or marginal. With cost of debt, which one did we come down on? With marginal. And what was the rationale? You don't remember, do you? Come on. How does interest save you money? You say interest expenses offset your last dollars of income, right? Because you subtract the interest expense from your total income. It's on the marginal last $100, last $100 million. That's why. But this is a tax rate across all of your income. So it's a little trickier, right? So let's try it out. Let's suppose you take Apple. The effective tax rate is 16%. The marginal tax rate is 25%, roughly US global average. If I use 25% as my tax rate for Apple, saying, I'm just going to use the marginal tax rate to be consistent, what am I going to end up with as a value? Too low a value or too high a value? Too low a value because I'm acting like they're going to pay 25% of their income in taxes when they're paying only 16%. So using the marginal tax rate all the way through is going to usually undervalue companies because most companies have effective tax rates lower than the marginal tax rate. I could go to the effective tax rate and leave it at 16% forever. I'm going to argue you're going to overvalue a company, and here's why. When I leave the tax rate at the effective tax rate in perpetuity, remember, a lot of the reasons you have low effective tax rates, you're deferring taxes. So if I leave the tax rate at 16% forever, what am I assuming about your capacity to defer taxes? You can do it forever. And if you believe that, there's a padded cell in a federal penitentiary waiting for you. Because you'll have to break some laws to get there. It's not doable. As your growth rates start to slow down, you're going to start to see your effective tax rates climb towards your marginal tax rate. So we're in a conundrum, right? Using the marginal tax rate all the way through undervalues companies. Using the effective tax rate all the way through overvalues companies. Can I split the difference and use the average of the two? Probably not a great idea either, but can I have my cake and eat it too? Can I start with the effective tax? I mean, there's no law that says my tax rate has to be same every year, right? So I can start with 16% for Apple, year 1, year 2. Why? Because you have really good tax laws, really good tax laws, really good tax laws. then I get towards my terminal value. Remember, whatever tax rate you build there is your tax rate forever. So I'm going to start at 16%. I'm going to move your tax rate towards whatever you tell me your marginal tax rate is. One of the options I give you in the spreadsheet is override it. The default in my spreadsheet is I do move you from the effective to the marginal over time. But if you have strong feelings that say my company is going to be able to keep its effective tax rate low forever, you can leave it at the effective tax rate, but do it with open eyes. You're assuming then that that climb towards the marginal tax rate will not happen at your company. So in computing after-tax operating income, there is an argument for using the effective tax rate, at least in the near term. But even there, over time, push your tax rate towards your marginal tax rate. And if you have negative effective tax rates, which can happen because you have two sets of books, just set a zero tax rate. Don't put in a negative tax rate, because then the government is sending you money every year. That's not the way the world usually works. Any questions? Let's go back to the money-losing company. Remember, when you lose money, usually you don't have to pay taxes. Thank God for that. But you also get a second benefit. Not only do you not have to pay taxes, you can take those losses and accumulate them. It's called a net operating loss or an NOL. And you open up a 10K for a money-losing company, you'll see the amount of that NOL that's built up over time. You know how that helps you? Is when you start to make money, you're allowed to take that NOL and use it to offset what taxes you could have paid. So let's take a very simplistic example. Let's say you have a company that has $1 billion in NOLs, and you expect it to make an EBIT, earnings before interest and taxes, of $500 million every year for the next 3 years. Richard, how much should I pay in taxes in year one on this company? I have $1 billion NOL. I make $500 million in profit, so no taxes, right? Because I use the NOL to cover it. When I do that, my NOL goes from $1 billion down to $500 million. I get to year two, I'm making another $500 million. I take the remaining NOL out, use it. So in year 1 and 2, I pay no taxes. In year 3, I start to pay taxes. You know, the reason I prefer to do it this way, many investment banks actually keep NOLs out of the valuation. At the end, they will multiply the NOL by a tax rate and add it on as a benefit. That's not the way the world works. You got to wait to get the NOL covered. And there's risk that you might never cover it if you don't make money. So what you will see me do is keep track of your NOLs over time. And when you start to make money, I will use the NOL. So there's a time value to money. It might not be till year 3 or 4. And I will discount it back to today using the cost of capital, which brings in the risk that your NOL will not pay off. So net operating losses is something you have to worry about with money-losing companies, because eventually, again, you're allowed to claim that to offset your taxes. So you'll see if you look at the bottom of my spreadsheet, if you're a money-losing company, I will keep track of not just your existing NOL, but every time you lose money, I will add to that NOL. It's one of the few advantages you get as a money-losing company, and then eventually I will use it. Any questions on NOLs? It used to be the old rules where you could not carry your NOLs for more than 7 years. Those rules have been removed. Now you can carry NOLs for as long as you want.
What about having some companies who write off? They don't do it.
But if you have no taxes, the writing it off, the only advantage of a write-off is a tax benefit, right? So that would not make much sense for me, because we can't use the NOL because you don't have taxable income. Writing it off doesn't help you either. All it does is if you have shown it as an asset on the balance sheet, it might make it a smaller asset, but from a cash flow perspective, it's doing nothing for me. So talk about CapEx. If you notice, through all my calculations of reinvestment, I offset CapEx against depreciation. So net CapEx is what I'm focused on, because depreciation pays for a big part of my cash flows, of my CapEx. Remember, depreciation is an accounting expense. It lowered my earnings, but it's still there. The cash is still there. So what you're tracking is that net CapEx. And I'm going to state a couple of very general principles about net CapEx. So let's say you're building a spreadsheet on your own. You got CapEx, you got depreciation. You say, what do I do? I can't help you on an individual company, but here's the general principle. The higher your growth as a company, the more I expect to see as net CapEx. Everybody agree with that? So if you want to grow 30% a year, I want to see more net CapEx than if you're growing 10% a year. Why? Because that growth has to come with some kind of reinvestment. And whatever assumptions you make about net capex have to be tied to your assumptions about growth. The reason I say that is I see a lot of investment banking spreadsheets where capex and depreciation are line items that are almost separated, uncorrelated with the revenue growth assumptions. And I can predict what's going to happen. Your revenue growth is going to keep going up. Your net capex is going to keep going down. Your value is going to keep getting inflated because I'm allowing you to treat these as independent items. So whatever assumptions you make about net capex and assumptions you make about growth, I don't disagree. You can make whatever assumption you want, but your assumptions can't be at war with each other. So in the old days when I used to let people build spreadsheets, and as I said, I'm going to try to let you not do that this year because it's a huge amount of work to go through full spreadsheets, is I would look at your growth number, then I'd look at your net capex number. And if the two didn't match up, you had a high growth and very little net capex, my comment is one of these has to change. You decide which one. I'm not going to force you to use lower growth or higher net capex, but tell me how these two coexist in your company. Now, again, if you think about the way accountants define capex, it's very narrowly defined. We talked about it in the context of R&D. Capex in a statement of cash flows traditionally is land, building, equipment, machinery. Very 20th century manufacturing company definition of capex. Our definition of capex and valuation has to be broader. It has to include things like R&D, right? We included R&D. If you do acquisitions, to me, acquisitions are just gigantic capital expenditures. So what you see as capex in the statement of cash flows and what you tell me the capex in your firm is can be very different numbers if the company grows through acquisitions. You might get lucky and the acquisition will be cash acquisition. You know why that's lucky? Because you'll see it in the statement of cash flows. But many of the biggest acquisitions companies make are off the statement of cash flows. Why? Because Disney, when it bought Fox, paid for it with shares. And when you do a stock-based acquisition, you got to dig through the footnotes to find it. The pain in the neck, but there's no way around it. Manish?
How would you amortize an acquisition?
Let it do it yourself. In a sense, the only reason depreciation matters is because it gives you a tax benefit, right? Amortization of acquisition, which takes the form of impairment of goodwill, is the ultimate non-item. It's a big item, but it doesn't give you any tax savings. So from that perspective, we might as well completely ignore it because why subtract it out and add it back when it's doing nothing to your taxes? Any other questions on net capex? So this, 1999, when I valued Cisco, in those days, you could actually get an acquisition classified as a purchase accounting or a pooling. The difference was when you did pooling, you didn't have to show, it was stock-based, so it effectively was off the books. The purchase accounting was cash-based. So look at all the small acquisitions. They were cash-based, the big acquisitions were stock-based. The only way I found the three big ones is by digging through the footnotes. But with Cisco, you had no choice. This is the way the company grew, is by doing acquisitions. I had to bring it in as a capex. I don't know how many of you are valuing companies that grow through acquisitions, but you're very quickly going to discover that valuing a company that grows through acquisitions is always much more difficult than valuing a company that grows with organic investments. Because the acquisitions are lumpy, they're uneven. Getting the information on what you're getting in return for your acquisition can be tricky. Do they pay with stock? You don't even know what they actually paid for the acquisition because it's not an explicit payment, it's an implicit payment.
Or
No.
what the expected cash flows of that.
You'd have to, yeah. And you'd get that if it's a big target company, but if you're doing 15 small acquisitions, you might not even get the financials of those. You have to take it on trust based on their history that they can turn these acquisitions around into something that will create growth and margins and profitability. So Cisco's net capex, if I believe the accountant was 98 million, but once I bring in the R&D impairment and the R&D capitalization and the acquisitions, their true net capex was 3.7 billion. 98 million, according to the accountants, 3.7 billion, if I do it right. Let's play it out. I actually use the 3.7 billion as my net capex. Give me the bad news if you're valuing Cisco, then what's it going to do to their cash flows? Make it a big negative number. But here's the good news. They're reinvesting a lot. So I'm going to give them a high growth rate to reflect that reinvestment. The net effect turned out to be positive in 1999 for Cisco. It very quickly turned against them 3 or 4 or 5 years later. But that's what you're trying to do with companies, is to bring in both the good stuff and the bad stuff. Because if you bring in just one side of the equation, you're going to get it, you're going to get a value that doesn't make sense. Last piece for today, working capital. Remember your accounting definition of working capital? Current assets minus current liabilities. I'm going to turn that definition around a little bit. In valuation, when we talk about working capital, we're looking at non-cash current assets and non-debt current liabilities. Let me explain the easier half of that equation first. If you look at current liabilities for any company, you'll see short-term debt and short-term portion of long-term debt. I'm taking them out and I'm treating them as debt in my cost of capital. So it's what's going to be left if I take those out. Accounts payable, supplier credit, deferred this, deferred that. So those items. Saying, why take cash out of current assets? Let's take another current asset, which is actually a cash flow inventory. The problem with inventory is it's a wasting asset. While it's sitting on the shelf, you can't make money. But cash is not a wasting asset. I mean, when I valued Google a couple of weeks ago, it's got 110 billion in cash. Know where it's invested? Hopefully not in Gemini. Yeah. It's invested in cash and marketable securities, T-bills, commercial paper. Earning what? A really low rate of return, 5%, maybe 5.5%. But if you or I invested in something liquid or riskless, that's exactly what we done. Cash has become a neutral asset, especially with companies' large cash balances. So I'm going to take it out of current assets. So it's non-cash current assets, which would be inventory, receivables, maybe a few other current assets, and non-debt current liabilities. That is the working capital that affects my cash flows. So try it out for your company, see what that number is, and what you're going to see is it's incredibly volatile number on a year-to-year basis. Look at it as a percentage of revenue, scale it to something. Otherwise, it can very quickly take over your valuation. So I'll see you on Wednesday. Again, reminder, first 30 minutes of class will be the quiz, and after that, we will complete our cash flow discussion.